Okay, so we are looking at monetary policy. Okay, this is how a central bank of a nation influences a country's economy through money supply and interest rates. Okay, money supply and interest rates. The central bank wants to influence the economy of a nation. Okay, so we want to look at the tools that are used by the central bank in monetary policy. All right, the first one is the policy interest rate or the discount rate. This one basically, this is the interest rate that the central bank charges commercial banks to borrow from. Okay, the commercial bank wants to borrow from the um, central bank. Obviously, there will be some interest. It's not going to be for free. Okay, so it's also called the discount rate. So the discount rate or the policy interest rate is the first tool that can be used. Okay. The second tool that is used is open market operations. This is where the central bank engages in buying and selling of financial securities. To be specific, treasury bills. Okay, short term financial securities, treasury bills. Okay, the central bank and other commercial banks and other businesses, all right? Central bank can either sell them treasury bills or buy treasury bills from them. Okay, one way or the other. Okay, and then finally, the third tool is the fractional reserve ratio. Okay, fractional reserve ratio. Okay, this is the what I'm saying reserve requirements. Okay, now this fractional reserve ratio or the required ratio. All right, this is the amount of money the central bank, I mean, a commercial bank keeps when you deposit money. Okay, remember every time you deposit money, that bank is going to use some of that money to buy, to loan out. That's what we call fractional reserve banking. Okay, and then we've got what we call the required reserve ratio, which is called the fractional reserve ratio. But here's the property, the required reserve ratio. This is the amount of money the commercial bank has to keep. Just hold on for this. Hello? Hi. Hello? Okay. Go to talk. Let me just finish up my class first. Hello, hello. Sorry, I was on a call. Yes, yes. Yes, I was talking about the required reserve ratio. Okay. I was calling it the fractional reserve ratio. It's the required reserve ratio. This required reserve ratio, it's the amount that the commercial banks keep whenever you deposit money. Let's say, for example, if the required reserve ratio, let's say it's 10%. Yes. So let's say if the required reserve ratio is 20%, so the RRR, triple R, is 20%. What this means is this: if you go in your bank and let's say you deposit a 1,000 kwacha, okay, with this required reserve ratio of 20%, it means the bank has to keep 20% of your money and the other 80% it can loan out. Okay, so fine. What is 20% of 1,000? That is 200 kwacha. Okay, so the bank keeps 200 kwacha. The remaining 800 kwacha, the bank can loan it out. Okay, that's the required reserve ratio. That is the third tool for monetary policy. Okay, the policy interest rate or the discount rate, open market operations, and um, the required reserve ratio. These are the three tools that the central bank uses. So we're going to now see contractionary fiscal policy and expansionary fiscal policy. We'll see how these tools are used for those type of fiscal policies. Okay, so we'll start with an expansionary, not fiscal policy, monetary policy. So we're going to start with expansionary monetary policy. Okay, here essentially, when we talk about expansionary monetary policy, think of low interest rates and a high money supply. Okay, lower interest rates, higher money supply. The main purpose of an expansionary monetary policy is the central bank wants spending to happen in the economy. You're in a recession. Okay, the economy is going in a recession, so it needs to pump in money so that there's money flowing, people are spending, people are getting employed, so that the economy gets back to its feet. Okay, so that businesses can keep on running and producing more. Okay, so expansionary monetary policy is usually done in terms of like recessions. Okay, when there's high levels of unemployment, right? GDP is falling. So the central bank would want to pump in money into the economy so that businesses can stay afloat, people can get employed, so that productivity gets back to increasing, right? And unemployment levels go down. Okay? The only problem with expansionary monetary policy, you're always going to have inflation eventually, demand pull inflation. Because as the central bank pumps in money into the economy, it means now people will be spending. Okay, and the more we spend, remember, inflation occurs when there's a lot of money chasing little goods, and the price of the goods go up. So eventually, that's one of the consequences of expansionary monetary policy. That eventually you're going to have demand pull inflation. But so long as that inflation is accompanied with productivity, then it's a good sign. Okay, so the central bank basically just wants to get the economy back up on its feet with expansionary monetary policy. So, with expansionary monetary policy, when we go to look at the tools, okay, this policy interest rate, what it's going to do is going to reduce the policy interest rate, okay, lowering the policy interest rate, right? Meaning, it's now cheaper for banks to borrow from the central bank. Commercial banks can borrow from the central bank, all right? And as they borrow, it means now they have enough money in their reserves to offer out as loans to people. Okay, so that's one thing this central bank can do with expansionary monetary policy: lower the policy rate or the discount rate. Okay. The second one, okay, in terms of open market operations, this the central bank will buy, okay, it will buy This is government securities, the treasury bills. Buy government securities, treasury bills from commercial banks, okay, and individuals. No, no, from businesses. No, from commercial banks. Sorry, when you buy these treasury bills from commercial banks, okay, when it buys them, it's putting money into the commercial banks. Okay, it buys government securities from commercial banks. Okay, when it's buying these securities, it's putting money into these commercial banks. The more money is in the commercial banks, now the commercial banks can loan out. Okay, they'll be able to loan out more money. And as they loan out more money, obviously, interest rates are going to have dropped. So it means now businesses can come and borrow money. The cost of borrowing would have gone down. Okay. So, in terms of open market operations, the central bank is going to buy, okay, treasury bills from the commercial banks. When it gets the treasury bills from the commercial banks, it pumps in money into the commercial banks. And when the commercial banks have money in their reserves, they have more money to loan out at lower interest rates, which is going to stimulate borrowing, and this borrowing will stimulate spending. Any questions? All right. Then the required reserve ratio. Okay, the central bank will lower it. Okay, central bank will lower the required reserve ratio. Okay. So for example, here, which that example I gave earlier on, if the required reserve ratio is 20%, when you deposit a 1,000, the commercial bank will keep 200, and the other 800 kwacha can loan. Okay. So if the central bank lowers this required reserve ratio, let's say to 5%, okay, it means if you deposit a 1,000 in there, they'll just keep 5%. 5% of 1,000, if I'm not mistaken, should be 50. Okay, so the commercial bank will keep 50 kwacha. Okay, keeps 50 kwacha. Then 950 kwacha can be loaned out. Okay, so this helps commercial banks loan out more money. Okay, because with this expansionary monetary policy, you want money to come into circulation. Okay, so that the economy can get back at its feet. Okay. Any questions before we look at contraction? Okay, now contractionary monetary policy. This is when the central bank has seen there is inflation in the nation. Okay. Demand pull inflation. Okay. So the central bank would want to cool off the spending. It wants to lower spending, right? So that inflation levels go down. So with contractionary monetary policy, we know that the central bank's aim is to lower the money supply and increase interest rates. Okay. High interest rates, lower money supply. Okay. So now the tools that it can use to implement high interest rates and lower money supply. First thing what they can do, we go back to the tools again, the policy interest rate. The central bank will increase it. Right. so that commercial banks, it's now more expensive for commercial banks to borrow. Okay, precautionary monetary policy. Okay, it makes the policy rate high so that central commercial banks cannot come and borrow from them. Or if they're borrowing, if there was excessive borrowing, that borrowing should stop. Okay, so that when they borrow less, it means in their reserves they'll have less money. Okay, or if they borrow at that high interest rate from from the central bank, if a commercial bank borrows at that high interest rate from the central bank, what do you think will happen to the interest rate they will charge you? They will charge you a higher interest rate, right? Higher than what they borrowed. Okay. Yes. And also, if the commercial banks, let me just hold on. Hello? Hello? Is it any point I'm seeing class? Sorry, I just got a call there. Yes. So that's the first thing they can do to implement contractionary monetary policy. They increase the policy interest rate so that it's more expensive for commercial banks to come and borrow. Okay, and when commercial banks borrow less, means also the reserves they have to borrow out will be low, so they'll charge you high interest rates. Or the commercial bank borrows at a high interest rate is going to also charge you a high interest rate. When it comes to open market operations, this is now where the central bank is going to sell. Okay, it's going to sell treasury bills, these government securities, sell government securities to commercial banks. So when they sell these treasury bills, these government securities, they're pulling out money from their reserves. Okay. And when they pull out money from the reserves of the commercial banks, means the commercial banks have less money to borrow out, which translates to high interest rates. Okay. Just remember, just imagine it like this. You as a person, okay, if you have got a 1 million kwacha in your account, if someone came to ask you, can I borrow some money? You might not even charge them with interest. You just say, okay, borrow it and pay me back when you have. And you might even forget. They might not even pay you back. Have you seen? Okay. Now, if you have got only a 1,000 kwacha in your bank account and someone asks you to borrow that money, you charge them a very high interest rate. Okay, a very high interest rate, so that because you don't have all that, you don't have a lot of money to buy. So that's the same thing. That's the same concept we're using with the commercial banks. The amount of money that they have to borrow out, if it's a lot, the interest rates will be low. Okay, but if there's less money, it means they're going to charge higher interest rates. Okay, so when the central bank sells these treasury bills to the commercial banks, it's pulling out money from the commercial banks, leaving less money in the commercial banks, which will translate to higher interest rates. So that businesses and government and whoever wants to borrow money, they'll be charged high interest rates. Okay. Then, when it comes to the required reserve ratio for contractionary monetary policy, they'll increase this requirement reserve ratio. Okay, let's say for example, Back to this example where it was at 20%. You would put in a 1,000, this commercial bank keeps 200. Now, if the central bank increases this required reserve ratio to, let's say, 50%, it means if you put in a 1,000 kwacha, the commercial bank is expected to keep 500 kwacha, and the remaining 500 kwacha they can loan out. So the aim is to lower the amount of money that can be loaned out when people deposit. Because, as I said, with contractionary monetary policy, you want to lower the money supply, money in circulation, and you want high interest rates. Okay, so it means you don't want to make too much money available to be borrowed. Okay, so when they increase the required reserve ratio, it means commercial banks have to keep more. Okay, and this will reduce how much they can loan out. Okay, and as we've seen, if the commercial bank has got less money to loan out, high interest rates. Any questions on that? Mr. Austin, Mr. Mpasa,